Hello friends, in this video we are going to cover best ways to lower investment risk in stock market. So you are, for example, if you are dealing on day-to-day basis in stock market, and of course you really need to make some strategy that will lower your risk while you are investing in stock market, because you have been completely dependent on this stock market, and you will somehow would like to know what are the ideas that can lower your investment risk while investing in the stock market. So we are going to cover this important video for you, and you can understand lot of things, how you can lower your investment risk in the stock market. So talking about the first part, which is diversification. So this is really one of the very important part if you really want to lower your investment risk. So what is diversification? Let us talk about this in little bit details. Diversification is absolutely one of the key ways to create a low risk portfolio. So this is really important part. You can't just avoid this diversification. So let us explain it in a little bit more details. By diversification, you are not pulling all of your eggs in one basket. So to speak it in a better way, we can say instead you are spreading your capital across a number of different companies or investments. So you are not putting all your money in a single basket. You are just putting in different companies or different parts. Investing everything you have into equities, for instance, can pose more risk than investing in a combination of stocks, bonds, real estate, and other commodities. So, if you have such kind of diversification that you are investing in a combination of stocks, bonds, then of course it is going to be better than investing just in a single company or single investment. Proper diversification of a stock portfolio would require a fairly large number of different stocks, covering a wide variety of companies and a diverse array of industries. So again, if you are going for this diversification, you really need to research about the different sector of companies and what have been the histories. But if you had done this diversification, you are going to achieve very good profit, as well as you are going to lower your risk to a big margin. For instance, owning 20 different technology stocks would be less diverse than owning one stock in each of the sectors of technology. For example, you have technology sector, healthcare sector, financial sector, industrial sector, utility sector, and customer goods. So if you are going to make such kind of diversification, that you are going to get into all these sectors, or or you can say that main sectors, then you are going to have a good diversification, because you are not just relying on a single sector that you really think that that is the best knowledge you have about. So in the first scenario, if something affected the technology sector or particular sector that you are dealing with, your entire portfolio can be adversely affected. But on the other hand, by diversification sectors as well as companies, a drop in one industry or corporation will not necessarily affect the others, thereby reducing your overall risk. So to conclude it, you really need to understand that if you are going with a large diversification, for example, different kind of portfolio, different kind of investments, then it's going to be good for you, because you're avoiding or you are safeguarding your money from getting a big loss all of a sudden, because there are sometimes the market falls for a particular segment. Now we are going to talk about the second important point, which is considering mutual funds and EFTs. So when being beginning, so let us talk about this. For example, in the first beginning to invest, some will argue that they do not have the capital available to diversify properly. They will buy one stock and pin their functional future on that one company. This is extremely dangerous and easily avoidable. There are two great options for those who either do not have the money to diversify properly or who really do not have the desire to research and follow so many different companies. So for those people, mutual funds and this EFT, which is also called exchange traded funds, are really great options. These two are really great options for those people. And again, these are great options for those who are new investors as well as experienced investors. We will discuss mutual funds and EFT in depth in a later video. So both type of funds are basically a group or collection of stocks. Mutual funds are professionally managed, meaning that on a day-to-day basis, the mutual fund manager is actively trading the stocks in the fund. His role is to maximize the return of the fund by following the mutual fund's investment objectives and goal outlines in its prospectus. Because there is a manager activity watching and trading all the stocks in the fund. The cost for the mutual fund can be relatively high. The trade-off is of course that you will have to instead diversification and in theory a professional manager seeking to maximize your return. So here also you really need to consider a little bit diversification, but these are really better option than just getting all the money at a single place. So exchange traded funds, which are also called ETF, are similar in some regards but quite different in others like mutual funds. ETFs are grouping of investment, usually stocks. The bigger difference is that ETFs are not actively managed. Instead, an ETF is put together and the stocks involved do not change. Because of this, the overall expenses are much lower, resulting in returns that often rival or exceed that of actively managed mutual funds. So this way you are going to lower your investment returns because you are going to avoid your investment risk because here you are going to consider mutual funds and EFT as alternative option. Now the third and last important point that we are going to cover as a best way to lower your investment risk is lowering risk via bonds. So bonds are a really a good way to diversify your overall investment portfolio because bonds typically pay out a set amount of interest on a specific date. This cash can then be reinvested into something else or simply used as income. Depending on your situation, it can be optimized. Bonds have typically showed returns that are lower than equities, although in the recent economic downturns, bonds showed a nice return comparatively. So young investors may choose to only own equities, which is fine. However, as you get a little older, stable investments such as bond becomes more and more important. Bond buyers should diversify as well. It is important to purchase bonds from a wide variety of issuers over a broad array of sectors. So here also you also need to consider diversification, but bond is really an alternative option. So another key to diversify bonds is also called laddering. This involves having bonds that come due over different period of time. For example, it would be wise to have bonds that come due in 10 years, 20 years, and 30 years, rather than all being due in 30 years. So this way you're going to make diversification among bonds as well. So this way long-term bonds can be really helpful for your investment or to safeguard your investment. So these are three important points that we have covered in this particular video that are always going to lower your investment risk. We hope this video has been very helpful for all of you. Have a nice day. Take care. Bye bye.